the moment trust replaced capital as the scarcest asset. Capital can be measured. It sits on balance sheets, audited and disclosed. Trust cannot be counted, yet it decides everything. Europe's banks learned this the hard way, because when confidence weakens, even strong numbers begin to lose meaning. To understand why this moment still matters today, we need to look beyond ratios, because the most fragile asset in finance is belief itself. For years, capital was a focus. Buffers were raised. Requirements tightened. Strength was quantified with precision. On paper, banks looked safer than ever. Loss-absorbing capacity improved. Supervision intensified. Frameworks signaled control. Yet markets behave differently under uncertainty. They do not ask how much capital exists. They ask whether it will be usable, whether support will arrive in time, whether others will stay calm. As stress emerged, attention shifted, not to balance sheets, but to behavior. Who hesitated, who reassured, who remained silent. Funding costs reflected this shift. Institutions with similar capital profiles faced very different reactions. Access depended on confidence, not compliance. Trust became selective. It clustered around familiarity, around perceived backing, around narratives that felt stable. This exposed a critical truth. Capital protects against loss. Trust protects against panic. And the two are not interchangeable. Europe had strengthened its banks, but it was now discovering that resilience also depends on credibility, communication, and belief in collective response. And once trust becomes scarce, it cannot be rebuilt by numbers alone. As trust thinned, markets became sensitive to signals. Small events carried outsized meaning. A delayed response, an ambiguous statement, a sudden policy shift. These moments mattered more than data releases. They shaped expectations. They influenced behavior. They determined access. Banks adapted quickly. They prioritized communication. They emphasized stability. They framed actions to reassure as much as to comply. But reassurance has limits. Words cannot replace belief. And belief depends on consistency over time. Authorities recognized this dynamic. They coordinated messages. They synchronized actions. They treated communication as a policy tool. Still, trust remained uneven. It flowed toward institutions seen as systemically essential. It bypassed others regardless of fundamentals. Perception outweighed metrics. This created tension. Strong banks felt undervalued. Weaker ones felt exposed. The system strained under uneven confidence. Cross-border effects intensified the problem. Trust aligned with national narratives. Support expectations varied. Integration faced psychological boundaries. Markets were not irrational. They were uncertain. And uncertainty amplifies every signal. Capital remained important, but it no longer dominated decisions. Liquidity access, policy credibility, and institutional reputation moved first. Trust had become the binding constraint. And once it began to ration access, stability depended on restoring belief, not just strengthening balance sheets. The conflict deepened as trust shortages began shaping outcomes, not gradually. Abruptly, institutions with similar fundamentals experienced radically different treatment. Funding lines tightened for some, others retained access with ease. The difference was confidence, not capital. This asymmetry fed instability. Perceived weakness became real pressure. Market reactions forced defensive behavior. Defensive behavior confirmed market fears. A feedback loop formed. Trust withdrew. Liquidity followed. Stress intensified. Authorities intervened to break the cycle. They provided guarantees. They expanded facilities. They signaled collective commitment. These actions worked, but only when they were believed. Announcements mattered as much as implementation. Speed mattered as much as scale. Banks learned quickly. Transparency became strategic. Silence became risky. Every action was calibrated for perception. Yet trust could not be commanded. It had to be earned repeatedly. Consistency mattered. Coordination mattered. Timing mattered. Cross-border coordination was tested. Mixed signals weakened credibility. Unified responses restored calm. Trust responded to alignment. The system stabilized, but it carried scars. Confidence became conditional. Belief depended on constant reinforcement. Europe had strengthened its institutions, but this episode reveals something deeper. Resilience is not just structural, it is psychological, and psychology moves faster than policy. The climax came when Europe accepted a quiet reality. Capital alone could not stabilize the system. Trust had to be managed, protected, and rebuilt deliberately. This changed how stability was defined. Strength was no longer just ratios and buffers. It was credibility, clarity, consistency under pressure. Authorities adjusted their approach. They treated communication as infrastructure. They emphasized predictability. They coordinated actions to protect confidence itself. Banks adapted too. They invested in transparency. They simplified structures. They recognized that reputation could not be hedged. The system emerged more aware, not weaker, but more honest about its limits. Numbers mattered, but belief mattered first. Today, Europe's banking system reflects this lesson. Capital remains high. Oversight remains strong, but confidence is monitored as closely as liquidity. Trust is no longer assumed. It is earned, maintained, and occasionally repaired. This is the hidden cost of modern finance. The stronger the system becomes on paper, the more stability depends on perception. Understanding this matters now, because future shocks will test belief before balance sheets. They will move faster than models. They will exploit doubt before weakness. And when trust becomes a scarcest asset, the system's survival depends on whether confidence can be restored in time. What the trust crisis also revealed is something about the asymmetry between building and losing confidence. Building trust is slow. It requires consistency over time, demonstrated reliability across many situations, the accumulated evidence that an institution or system will behave predictably, even when behaving predictably is costly. Losing trust is fast. It can happen in a single session, a single ambiguous statement, a single hesitation at a moment when decisiveness was expected. That asymmetry is not a failure of rationality. It reflects something real about the underlying problem trust is solving. Trust exists because information is incomplete. Participants in financial markets cannot fully verify the quality of counterparties, assets, or commitments. They must rely on signals. And signals are inherently subject to interpretation. When a signal is strong and clear, it builds trust quickly. When a signal is ambiguous or absent, it erodes trust quickly, because in the absence of clear positive signals, the rational response is to assume the worst, to act defensively, to protect against the possibility of a loss that cannot yet be quantified. That defensive behavior, multiplied across many participants simultaneously, is what produces a kind of funding withdrawal and market freeze that Europe experienced at the height of its banking stress. Not irrationality. Coordinated rational response to insufficient information. This is why communication became such a critical tool, not as public relations, as information policy. Clear, timely, credible signals from authorities about their intentions and capabilities. Substitute, partially, for the information that participants cannot obtain directly. They tell markets how to interpret ambiguous situations. They coordinate expectations. They make the collective behavior of the system more predictable. And predictable collective behavior is the closest thing to trust that an institutional framework can manufacture at speed. Europe learned this. The ECB's communications became more deliberate. The language of commitment became more precise. The signals about what would and would not be done became clearer, not because the underlying situations became simpler, but because the authorities became better at understanding that their words were part of the policy instrument, that what they said shaped what markets expected, and what markets expected shaped what markets did, and what markets did shape the outcomes that the policies were trying to achieve. That feedback loop between communication and behavior is what makes trust a policy variable rather than merely a cultural condition. It can be influenced, not completely, not reliably, but more than most frameworks acknowledge. And the acknowledgement that it can be influenced is the beginning of treating it seriously enough to try. Europe's banking system is better at this than it was. Not perfectly, but noticeably, the tools exist. The understanding is deeper. The willingness to communicate clearly, even when clarity is uncomfortable, has grown from experience of what happens when it is absent. That growth is real, and it is fragile because it depends on leadership that understand the lesson. And leadership changes the moment